Let's move ahead. We have another company on the radar as well. EClerx reported numbers just a few days back. The first quarter was slightly muted for the company. The constant currency revenue growth came in a bit below street estimates. Margins were impacted in the first quarter due to wage hikes and senior level hires. We have with us Srinivasan Nadadhur, CFO of EClerx. Srinivasan, thank you so much for joining in. Let me start with the margin question first. So the way our team calculates margins is we don't look at other income and therefore the numbers. So your margin has dipped to around 17.2% in the first quarter versus about a level of 21%. And even if we go by, your company calculations, I think you're just below the range. You've guided for 24 to 28%. First quarter, you were at 23.3%. So just explain to us, is it only because of the hiring or are there any other sort of cost pressures? What about deal pricing as well? It's a wide range you've given, 24 to 28%. Usually companies give, like 150, 200 basis points. So what is the margin profile that you're looking at for the rest of the year?
Sure. Thank you for having me on the call. To answer your question, the 400 bips drop in margin, whether we look at our calculation or yours, is largely because of two things. One is the wage hikes, which I would assume is somewhere between 60 to 70% of that overall drop. Another 20% because of business development hires and augmenting our sales capabilities. And the remaining is because of other items like electricity, rent, and so on and so forth. And that's why sort of our margin has come below the guided range of 24 to 28. But that is typically what happens in Q1 of every year. So even if you look at the same quarter last year, I think we had dropped maybe 506 bips according to our calculation. And we think that we will be able to recover this over the next 3 quarters because of increases in revenue, because of replacement hiring, thanks to attrition, and therefore we will be able to come back within that range that we have guided for.
We are practically, halfway down the year. The second quarter is also practically coming to an end. So the visibility that you have now, do you think you will be closer to the upper end of that guidance or the lower? Because the wage impact will be made up, as you're saying. So then it's really all about business, the pricing that you're able to get, and the deal momentum.
Yeah, so at the moment, it would be safe to assume that we will be somewhere around the middle. That's how I would look at it.
Middle of the range.
Yeah.
Got that. Srinivasan, hi, good morning. Prashant here. What about top line growth? Because I think we are at low single digits right now, right? Last time we spoke, you'd said that you'd aspire for double digit, you'd aspire for double digit growth. Could you give us would you like to reassess that? What should we expect? What should we pencil in?
Well, given the deals that we have signed in this quarter, there seems to be healthy momentum. Given the pipeline of deals that we have, which is also very healthy, we are going to stick with our original aspiration of double-digit growth. So we do think that things will improve from Q2 to Q4.
This is an aspiration, or this is you said aspiration, but you're confident you'll be able to do it?
We are reasonably confident. We are reasonably confident
25.
we'll be able to do it.
Okay.
Let's talk about double digits. So we are reasonably confident about hitting double digits.
Okay, so give us some more color on that, Srinivasan. Where do you see demand picking up in terms of verticals, in terms of geographies? What will get you to that double-digit revenue target this year? And is it going to be sustained? Because in the last couple of years also we were coming off COVID, etc. So the full year growth numbers have been very patchy, from very high levels to just dipping below the double-digit mark. So will this 10% plus be sustained? And some color on the geographies and the verticals that are firing up.
Sure. Of the 3 businesses, I would say our financial markets continues to show the most opportunities. So we are seeing a lot of deals thanks to regulatory pressures in our client geographies. So that's leading to a lot of work for us. Then in our customer operations, again, we see opportunities to improve in customer experience and chat, voice support. On the digital, it's a bit of a mixed bag. So we are seeing demand in some pockets in high tech, etc. But luxury and manufacturing continues to be a little bit of a, I would say, constraint. So that's the overall picture for our three businesses.
All right, Srinivasan, final question before we let you go. You're sitting on a good amount of cash, I think 1,000 crores odd. What's the utilization plans out here? Return some back to the shareholder, or is there some inorganic growth on the anvil?
Yeah, we just did a buyback in Q1. So I think that's not reflected in the Q4 cash position.
Okay, so it'll be relatively lower then, the cash in books.
That's correct.
All right, and no inorganic growth?
We are still looking, but nothing conclusive so far.
Okay, we'll wait by then for an announcement on that front. Thanks a lot, Srinivasan, for joining in and giving us all those details, how you see business shaping up.